how are you going to do something about an inflation problem by throwing gasoline on it? Because a 1% interest rate is still a stimulative rate of interest. In fact, 1% is the rate that Alan Greenspan slashed interest rates to in 2002 when he wanted to stimulate the economy following the September 11th attacks and the collapse of the NASDAQ bubble. That was considered a very stimulative monetary policy, yet somehow now it's an aggressive tightening that's going to take care of the worst inflation in 40 years. And the reality is, it's not the worst inflation in 40 years, it's the worst inflation ever. Because 40 years ago, when we were measuring inflation, we were using a very different CPI than the one we're using now. So you can't really compare the CPI today to the CPI 40 years ago when they're completely different. So if you measured what happened to prices last year with what happened 40 years ago using the same CPI that was being used then, in 2021, we had an increase in consumer prices of about 15%. And that would make it higher than any year of the 1970s. In fact, it would be higher than 1980, which until last year was the high watermark for the CPI at 13.5%. But how did we put out the inflation fire in 1980? Well, Paul Volcker brought interest rates all the way up to 20%, so that we had a real rate of interest of 6.5%, and we created a powerful incentive to hold on to US dollars and to save money because we offered savers a very high real yield on their savings. And of course, Treasury bond yields also soared. I think the yields on 30-year bonds got up to something like 14%. And so we were offering a positive yield. Inflation, even if you believe the government's numbers, which I don't, at 7%, 1% is still a negative 6% interest rate. You are not going to encourage savings with negative 6%. You're not going to discourage debt. You're not going to do anything to change the dynamic. You're not going to get out in front of the inflation curve. You're going to fall further and further behind if you continue to stimulate with cheap money. Now, yes, it's not as cheap as it was, but if inflation continues to accelerate, which it likely will, real interest rates will actually be falling, even as the Fed is slightly raising nominal interest rates. So they're actually pursuing a more stimulative policy while pretending to tighten. So they're continuing to make this inflation problem worse. But here is the bigger problem. The only way the Fed was able to justify these artificially low interest rates and quantitative easing was under the pretense that an absence of inflation gave them the leeway to do that. Now that inflation is triple or more, 2%, there is no way the Fed can justify maintaining the artificially low interest rates, because even if they raise interest rates 2%, they're still artificially low. The only reason that the Fed kept rates so low was because we had such a gigantic debt bubble that those low interest rates were the only thing keeping us afloat. If interest rates were allowed to normalize, we would have a far worse financial crisis than 2008. We would have all the big banks that we bailed out failing. We'd have a crash in the stock market. We have a crash in the real estate market. And not only would the private sector have difficulty servicing its debts if the Fed were to allow interest rates to go to a natural level, but the United States government would also be in the same predicament, maybe even in a worse predicament. The US government would be forced to default on its national debt. So the reality is the Fed is caught between a rock and a hard place. There is no way out. There's only a bad choice and a worse choice. The bad choice is to fight inflation, let interest rates go up, and let everything collapse. The worst choice would be to continue to create inflation to avoid that and postpone the consequences of hyperinflation. But unfortunately, that's likely the choice that they're going to make. And so what do investors need to do based on this new reality? Because even though the Fed is still going to be providing cheap money, it's not going to be cheap enough to sustain the bubble. The air is already coming out of the bubble merely based on the fact that the Fed is talking about tiny rate hikes in the future has already collapsed a lot of the bubble stocks. A lot of these stocks are down 50% or more. They're going to continue to fall. In the meantime, look around the world. As I'm speaking, I think the Nasdaq's down about 14%. S&P was off about 9%. Foreign markets are up, especially if you look at the value stocks. We're seeing huge rallies in dividend-paying stocks in Europe and Asia, stocks that have been left for dead for years, stocks that were used as a source of funds. People are now piling into those stocks as they liquidate these overpriced assets, because you can't go to cash right now. In an inflationary environment like the one we're in now, if you want to get out of overpriced US stocks, companies that don't earn money, that trade on a dream, that have high PEs or no E's at all, and they just, trade on hope and a prayer, as people are selling these stocks because the momentum is no longer there, they can't go to cash because inflation is going to destroy the value of their cash. They can't go to bonds because they have the same inflation problem with bonds, only worse, because they can't get their cash until the bonds mature, and they could take a huge loss on the bonds if they want to sell prior to maturity, as ultimately long-term interest rates go up. So where do you go when you get out of overpriced US stocks? Well, you got to go into underpriced foreign stocks, which basically allows you to accomplish two things. You get out of US stocks and you get into better valued companies that actually make money right now, not potentially in the future, but that make money right now, making things, selling things, generating earnings, and paying dividends. But you also get out of the US dollar, because the dollar is going to collapse when people understand that the Fed has no ability to control inflation, and inflation is going to continue to erode away the value of the dollar. What's really going to cause this recession is inflation, because inflation is going to drive the cost of living up so high that Americans are going to be spending a very high percentage of their disposable income on the basic necessities: food, energy, rent, insurance, healthcare. They're not going to have money left over for discretionary spending. And that means the people who earn a living in the part of the economy that benefits from that discretionary spending, they're going to be unemployed. You got to get out of the dollar, and you need to be in inflation hedge investments. One, obviously, being gold and silver. Prices are going to go up dramatically. I think we're going to have another leg similar to the leg we had from 2001 to 2011, where gold was up about 5x. It could easily happen again. Forget about tech stocks. They're old news. They worked in the past. They're not going to work in the future. What's going to work is what worked in the 1970s, the last time we had stagflation. Of course, this time it's going to be far worse. The inflation is going to be much worse. The economy is going to be much weaker. And unfortunately, we won't be able to put a stop to it like we did in 1980, because we have no ability to raise interest rates because the country is completely insolvent, which was not the case in 1980 when we were still a wealthy creditor nation. We still had trade surpluses. We had relatively small debt relative to GDP, the mirror image of America today. So we're not going to have a positive ending. We're going to have something completely different and catastrophic. And so it's even more important that you stagflation proof your portfolio, because it might end up being an inflationary depression, not just a recession, but a depression. And the inflation could end up being hyperinflation. And so you also want to get into foreign equities. I think that should be the bulk of a portfolio, good dividend paying foreign equities. So you need to follow that blueprint.